Picture this moment. The year 2024. Italy's economy has grown at 0% per capita since 1999. Zero growth. Not a temporary recession. Zero. Your wages in real terms haven't moved since then. Your neighbour's wages haven't moved. The bar owner downstairs, his real income sits exactly where it was when rent was €50 monthly. Meanwhile, across the Alps, Germany's workers got 50% richer over these years. France added 40%. Italy? Nothing. Flat. How does zero growth happen inside Europe's richest currency union? Did this happen by accident, or was it baked into the system? This isn't temporary. This is a quarter century of mechanical stagnation. But Italy wasn't always this way. During the 1980s and 1990s, your country worked differently. Small manufacturers across Tuscany, Veneto, and Emilia-Romagna competed fiercely. When they needed it, the lira devalued automatically. Currency flexibility meant your firms could adjust. Capital flowed, productivity climbed steadily, workers earned more. Then 1999 arrived. Everything changed. The euro came in, and the rules shifted instantly. No more currency escape valve, no more quick adjustment. No way for your entire country to reset relative wages anymore. What happened after that is a quarter-century lesson in how institutional constraints reshape entire economies. Italy's government debt sits at 140% of GDP today. For every single euro your country generates, creditors own 1.4 euros. That's unsustainable. Most nations carrying this level of debt can adjust somehow. They can devalue their currency. They can inflate away the burden. They can export more. Italy cannot do any of these things. The Eurozone prevents currency devaluation explicitly. Your inflation gets constrained by the ECB, your competitiveness declining steadily. Your interest payments consume roughly 4% of every euro produced annually. 4% goes to interest payments. 4% doesn't go to schools or infrastructure or research. That money vanishes. What happens when 4% of your output just disappears into debt service? Here's the harder problem. It's not just your debt. Italian firms actually stopped getting better. Total factor productivity turned negative in the 2000s. Did it recover? No. Never. Think about what productivity means practically. Are your firms doing more valuable work per person? Are better companies growing faster? Did innovation accelerate? In Italy, none of that happened. Why not? The research is brutal. When the euro arrived in 1999, borrowing suddenly got cheap everywhere. Capital flooded in. Instead of flowing to your most productive companies, it went everywhere equally. Weak firms got money. Good firms got money. Misallocated firms got money. Economists calculated recently, if capital had simply gone where it should have since 1995, your GDP would be 18% higher. 18%. That's trapped potential. Now watch what unfolds in labour markets. Italian firms manage capital they can't use efficiently. They still face rising wages because workers demand better lives. German firms become steadily more productive. They keep wage growth moderate. Italian firms can't match Germany's productivity per worker. But they have to match its wage levels somehow. Your unit labour costs relative to Germany climbed higher and higher. By the early 2000s, Italy found itself locked into a cost structure it couldn't maintain. Under normal circumstances, what would happen? Currency markets would devalue your wage structure. Your firms would adjust automatically. Inside the euro? No such adjustment is possible. You experience slow, grinding loss of competitiveness year after year. That's visible in export numbers since 2000. The generational cost became visible after 2008. Youth unemployment in Italy peaked at approximately 43%. Almost half of your young people couldn't find jobs. In Germany, during the same period, 6.7%. That's not recession-level difference, that's structural difference. Why couldn't your young people find jobs? Firms weren't expanding. Why weren't firms expanding? They were stuck managing misallocated capital while losing competitiveness continuously. So an entire generation didn't build career skills. They didn't invest in themselves. They didn't form families at normal rates. The social costs became immense. Because they couldn't find stable employment, Your government had to spend more on welfare. That pushed public debt higher. It narrowed room for productive investment, a trap feeding itself completely. Then 2008 arrived. For most of Europe, the financial crisis was a sharp, terrible shock. For Italy, it was something different. It was a reveal. The misallocated capital your firms had been carrying? It had never been productive. Firms couldn't service their loans anymore. Your government couldn't print money to bail out banking. Eurozone rules forbade it. The ECB had to step in very slowly. But by the time they did, Italy's non-performing loan rate climbed faster than anywhere else in the Union. Did the crisis cause your underlying trap? No, it exposed the trap completely. What happens when an exposed trap compounds? Firms cut investment, productivity falls faster, debt becomes harder to service. The structural problem became impossible to ignore. Think about what happens when a region in Britain faces stagnation. Workers migrate to London. Capital migrates toward higher returns. Wages in weak regions fall relative to strong ones. The pound weakens. Multiple escape valves exist. Italy has none of these inside the Eurozone anymore. Labour can move to Germany. Can your nation as a whole move? No. Capital can theoretically move. Does it? No. It stays trapped in low productivity uses. Wages cannot fall significantly without severe political upheaval. Your currency cannot move by design. You're left with one adjustment channel: structural reform. Firms must become much more productive. Your government must cut waste. In theory, it's possible. In practice, inside a democracy with zero growth and high debt, it's nearly impossible. Why? Reform creates immediate pain for workers. Growth gains remain distant and theoretical. That's why Italy reforms slowly. Here's where the trap becomes darkest. Your government debt is extraordinarily high. Even small interest rate movements matter enormously. The European Central Bank kept rates extremely low for years after 2008. That policy was survival. But when the US Federal Reserve and other central banks began normalizing rates, the ECB had to follow them. Each rate increase pushed your government's debt servicing costs higher, significantly. 4% of your entire national economic output now flows to interest payments on old debt. 4%. Could that money have gone to schools? Yes. Infrastructure? Yes. Research? Yes. Does it? No. It vanishes. A nation paying 4% of its entire economic output just to service debt cannot invest in its future at all. That's not a budget problem, that's a cage. Italy's government deficit is currently around 3.1% of GDP in 2024. That's above the Eurozone's official 3% rule. The European Union is watching carefully. They won't forgive significant deviations much longer. So what happens to your policymakers? Can your government spend money to stimulate growth? No, not without violating fiscal rules. Can it cut spending significantly without triggering recession? No. Can the European Central Bank devalue the currency? No. Can it cut rates much further? No. Think about it. Every major policy tool is either completely broken or institutionally forbidden. This isn't incompetence, it's not mismanagement, it's mechanical. Italy isn't trapped because it's been mismanaged, it's trapped because it's mechanically constrained by the institutions it joined. But let's ask, what if your country reformed very aggressively? What if firms got much more productive very fast? The mathematics allows for it. Remember that 18% figure? That's trapped potential from misallocated capital. Unlocking it is theoretically possible, but it requires something unusual, a decade of substantial structural pain accepted voluntarily by voters, labour market reform that displaces workers, bankruptcy law changes that force bad firms to close entirely, education investment that takes 15 years to pay off, tax system changes. Political consent for that magnitude doesn't exist in functioning democracies, especially not when your growth is zero. When does pain hit? Immediately. When do gains arrive? Distant, theoretical future. Reform happens when countries reach desperation. Is Italy desperate? Not yet. Italy is uncomfortable, not desperate. So reforms stall predictably. Every government tries, then retreats. Italy isn't entirely abandoned, though. The European Union's Recovery Fund pumped roughly €200 billion into your country for green energy transformation, digital infrastructure, and research investment. That's real money. But here's the critical catch. Every euro is conditional on reform. Spend it on productive investment. Don't let it leak into politically connected firms. That's the theory. In practice, directing capital efficiently is precisely what Italy proved it couldn't do since 1999. Your capital allocation problem is structural. Is the fund helping? Yes, slightly. Has it solved your underlying misallocation problem? No. It's a pressure valve. It's not a structural fix to your economy at all. So what does realistic recovery actually look like? Not a miracle. Not a return to strong growth tomorrow. Italy's plausible scenario is this: productivity improvement at 2% annually over the next decade. That's above trend, but genuinely achievable if your firms restructure systematically. Close unproductive units permanently. Reallocate capital to better uses. Labour costs flatten relative to Germany through wage restraint and improved output per worker steadily. Your competitiveness edges back slowly. Exports improve slightly. Your debt-to-GDP ratio stops climbing catastrophically. Does that happen by 2035? Maybe. Maybe your debt actually declines. Real income per capita climbs again. We're talking about a slow grind. Is 2% dramatic? No. Is it not zero? Yes, but every single year of delay makes the mathematics harder. Your debt compounds. Young people continue leaving or remain trapped in precarious employment. Aging accelerates. Italy's population is shrinking. Fewer workers support more retirees. The debt math shifts further against the future. Infrastructure decays. Skills deteriorate. What happens if your country waits another 5 years? Your debt might climb to 150%. The cost of future reform grows larger. The window closes. Not dramatically, but persistently. That's the real pressure in Italian politics. It's not a crisis clock with a deadline. It's a demographic and fiscal clock ticking quietly. Does time make this problem easier or harder? Italy's story is not unique inside the euro. Greece, Portugal, and Spain all went through versions of this mechanism. Does the currency union actually work? Only if all members maintain roughly similar productivity and competitiveness. What happens when they diverge? It breaks. Italy diverged starting in 1999. The currency was too strong for its productivity level. Wages were too high for its growth rate. Capital got systematically misallocated. Did the Eurozone have a mechanism to catch this early? No. Can you fix it now? Only without aggressive reform, which is politically painful, or leaving, which is politically unthinkable. So Italy persists in the middle ground, trapped, uncomfortable, but not desperate enough to change. For the Eurozone, that's a permanent vulnerability. Return to that image from the beginning. The year is 2024. Your real wages haven't moved since 1999. Your neighbours haven't moved. The bar owner's income hasn't moved. On the balance sheet, why? The reason is mechanically clear. Italy entered a currency union when its firms were systematically misallocating capital at enormous scale. Cheap euro credit masked the problem until 2008 exposed it. Now productivity is low, debt is 140%, and every adjustment channel is either broken by design or institutionally forbidden. Is Italy mismanaged? No. Is it mechanically trapped? Yes. And for a nation locked inside the world's largest currency union, that trap might be the hardest kind to escape. Is leaving unthinkable? Yes. Does staying mean accepting 0% growth as the structural baseline? Yes. 0 is the baseline now.